How interest rates impact the housing market. Understanding how interest rates impact the housing market is crucial for both buyers and investors. These rates determine the cost of borrowing, influencing affordability, demand, and overall market dynamics. From shaping home prices to affecting housing supply and market cycles, the role of interest rates extends far beyond simple mortgage payments. This intricate relationship underscores the broader economic effects of monetary policy and its influence on real estate trends. Number 10. Influence on mortgage affordability. Interest rates directly affect mortgage affordability, influencing the housing market. Lower interest rates reduce monthly mortgage payments, making homes more affordable for buyers and increasing their purchasing power. This can lead to a surge in home purchases as buyers take advantage of favorable borrowing conditions, boosting market activity. Conversely, higher rates increase monthly payments, potentially pushing some buyers out of the market and causing a slowdown in home sales. Higher rates can also lead to increased financial strain on current homeowners, impacting their ability to manage existing mortgages. A sustained period of high rates can lead to a broader market correction as affordability becomes a significant barrier. How does this shift in interest rates transform the dream of homeownership from achievable to out of reach? Number 9. Effect on housing demand. When interest rates are low, borrowing is cheaper, which can boost housing demand as more buyers enter the market, increasing competition for homes. This increased demand often drives up home prices, creating a competitive market where bidding wars become more common. Additionally, lower rates can encourage existing homeowners to upgrade or invest in new properties, further inflating demand. Conversely, high interest rates can dampen demand, reducing the number of qualified buyers and slowing down the housing market. Higher rates may also discourage first-time buyers from entering the market, creating a ripple effect on overall housing activity. What happens when a simple change in interest rates sends ripples through the entire housing market? Number 8. Impact on home prices. Interest rates play a crucial role in determining home prices. Low rates typically lead to higher home prices as more buyers compete for limited properties, pushing prices up. In a low-rate environment, sellers may price their homes higher, knowing that buyers can afford larger mortgages. Additionally, the increased demand driven by low rates can lead to bidding wars, further inflating prices. On the other hand, high rates can suppress home prices due to reduced buyer purchasing power and lower demand. This relationship creates a direct link between interest rates and the overall cost of purchasing a home, influencing market valuations. Higher rates can also lead to longer time on the market for sellers. How do fluctuations in interest rates create a seesaw effect in home prices across the nation? Number 7. Influence on housing supply. Interest rates also impact the housing supply. Lower rates can encourage homebuilders and developers to invest in new projects, increasing the overall housing supply as construction becomes more financially viable. This increased supply can help meet rising demand and stabilize home prices, creating a more balanced market. Additionally, lower rates can make financing for development projects more accessible. Higher rates, however, can make borrowing more expensive for builders, leading to a slowdown in new construction and a tighter housing supply. This reduced supply can exacerbate housing shortages and drive up prices, creating a market imbalance. How does a rise or fall in interest rates ripple through the construction industry, altering housing availability? Number 6. Impact on refinancing trends. Low interest rates often lead to increased refinancing activity as homeowners seek to capitalize on lower borrowing costs, potentially reducing their monthly payments or accessing home equity. This surge in refinancing can result in more homeowners staying in their current homes longer, reducing the turnover of properties available for sale. Conversely, higher rates can decrease refinancing activity, leading to fewer homeowners refinancing their mortgages and potentially increasing the number of homes for sale as people move for other reasons. This shift in refinancing trends can affect the overall housing market and supply dynamics, creating opportunities for new buyers. How do interest rates influence homeowners' decisions to stay put or move on? Number 5. Effect on first-time homebuyers. Interest rates have a significant impact on first-time homebuyers who are often more sensitive to changes in borrowing costs due to their typically limited financial resources. Low rates make it easier for these buyers to enter the market as lower monthly payments improve affordability and access to homeownership. Additionally, favorable rates can boost their confidence in making a purchase and securing a long-term investment. High rates, however, can make homeownership less attainable by increasing mortgage costs and reducing the affordability of homes. This impact can shape the overall demographic of buyers in the market and influence the type of homes being sought. How do fluctuations in interest rates shape the dreams of first-time homebuyers across the country? Number 4. Influence on real estate investment. For real estate investors, interest rates affect the cost of financing investment properties and the attractiveness of real estate investments. Low rates make borrowing cheaper, which can boost investment activity and encourage purchasing more properties, potentially leading to higher rental yields and returns. This increased investment can lead to a more competitive market for rental and investment properties. Higher rates, however, can deter investors by reducing the profitability of potential returns and making financing more expensive, which can lead to decreased investment activity. This can affect market dynamics, including property values and rental rates. How does the cost of borrowing shape the strategies of real estate investors and the overall investment landscape? Number 3. Impact on housing market cycles. Interest rates play a crucial role in housing market cycles, influencing both expansion and contraction phases. During periods of low interest rates, the housing market may experience rapid growth and increased activity, often leading to a boom phase characterized by rising home prices and heightened sales. Conversely, high interest rates can lead to a market slowdown or contraction, affecting home sales and prices as borrowing becomes more costly. These cycles can impact long-term market trends and influence investment decisions, creating periods of growth and recession in the housing market. The cyclical nature of the market means that interest rates can contribute to both housing booms and downturns. How do the ebb and flow of interest rates drive the rise and fall of housing market trends? Number 2. Influence on homeownership rates. Interest rates impact homeownership rates by affecting mortgage affordability and overall housing demand. Lower rates typically encourage more people to buy homes, leading to higher homeownership rates as borrowing becomes more accessible and affordable. This can contribute to a broader goal of increasing homeownership across various demographics. Conversely, higher rates can limit access to mortgages, potentially lowering homeownership rates and affecting housing market health. This impact on homeownership rates can influence broader economic trends, including consumer spending and economic stability. Additionally, changes in rates can affect the equity accumulation and financial well-being of homeowners. What does the ebb and flow of interest rates mean for the broader goal of homeownership in America? Number 1. Role in economic stability. Interest rates are a key factor in maintaining economic stability, including in the housing market. Central banks adjust rates to manage inflation and economic growth, which indirectly affects the housing market by influencing borrowing costs and investment conditions. Low rates can stimulate economic activity and boost housing markets, encouraging spending and investment. Conversely, high rates can cool down overheated markets and prevent bubbles by reducing borrowing and spending. Additionally, interest rate adjustments influence consumer confidence and spending patterns, impacting overall economic conditions and shaping the housing market's future trajectory. How do central banks' decisions on interest rates set the stage for economic stability or instability in the housing market? Thank you for tuning in. If you enjoy the content, please hit the like button and subscribe to stay updated with our latest videos on YouTube.